As of Monday, January 12, 2026, the stock market is currently closed, with Nvidia trading under the ticker symbol NVDA, sitting at a closing price of $184.86. During the last trading session on Friday, January 9th, the stock experienced a slight intraday decline of 0.10%, shedding about $0.18 per share. While this minor dip might seem like noise in the grander scheme of the stock's meteoric rise over the last few years, the underlying movement suggests a fascinating tension between retail optimism and institutional repositioning. Most investors looking at the ticker today see a Titan that is consolidated roughly 20% below its recent $5 trillion market cap peak, but the reality is that we are witnessing a quiet, tactical shift in how the largest desks on Wall Street are valuing the next phase of the artificial intelligence build-out. The common consensus right now is that Nvidia is the undisputed king of silicon, a company so dominant that its competitors are essentially fighting for scraps. However, while the retail crowd on platforms like Reddit and X is fixated on the upcoming Vera Rubin architecture and the potential for the stock to breach the $200 mark, institutional players are performing a much colder audit of the return on investment for the enterprises buying these chips. There is a growing divergence between the raw performance of the Blackwell platform and the actual bottom-line growth of the companies deploying it. This creates a curiosity loop for the week ahead. If the fundamentals are stronger than ever, with a reported backlog of $500 billion, why has the stock been fighting to hold its $188 pivot point rather than surging to new highs? The answer lies in the great rotation of early 2026, where capital is being pulled from high-growth tech and tucked into defensive sectors like utilities and consumer staples as a hedge against macroeconomic uncertainty. Looking closely at the intraday swings in trading volumes from the past week, we see a pattern of controlled distribution. While retail volume remains high, institutional 13F filings for the beginning of the year indicate that several top-tier hedge funds have trimmed their overweight positions. This isn't necessarily a vote of no confidence in Nvidia itself, but rather a reflection of crowd psychology entering a period of disbelief. Traders are increasingly frustrated by the fact that even record-breaking revenue beats are being met with sell-the-news reactions. On the social sentiment front, there is a palpable sense of annoyance regarding perceived market manipulation and the role of dark pool trading, which recently accounted for over 35% of the off-exchange short volume. Retail investors feel the stock is being artificially suppressed, while the data suggests that large-scale funds are simply waiting for more clarity on the timeline for agentic AI to start driving software revenue for the rest of the Magnificent Seven. The financial health of the company remains staggering, and this is where the expectation versus reality dynamic gets interesting. Nvidia recently reported a third-quarter revenue of $57.0 billion, which was a 62% increase from the previous year. Their data center segment alone brought in $51.2 billion, representing over 85% of their total business. When you look at their gross margins, which are hovering around 73.6%, you realize that they are operating with an efficiency that is almost unheard of for a hardware manufacturer of this scale. The company has returned $37 billion to shareholders through buybacks and dividends in just the first 9 months of the fiscal year. Yet the market is no longer reacting to these numbers with the same exuberance as it did in 2024. The bar has been set so high that even a $65 billion revenue forecast for the next quarter is viewed as meeting expectations rather than exceeding them. To understand the core of the business, we have to look past the stock ticker and into the architecture of their success. Nvidia isn't just selling chips anymore, they are selling entire AI factories. Their business model has transitioned from a component supplier to a full-stack platform provider. With the Blackwell platform now in volume production and the recent unveiling of the Vera Rubin series at CES 2026, they have effectively established a moat that is reinforced by their CUDA software and Spectrum-X networking hardware. By controlling the networking layer, Nvidia ensures that their GPUs can communicate at speeds that make it nearly impossible for a competitor like AMD or Intel to offer a compelling alternative for large-scale clusters. They are also expanding into automotive and robotics, with their Drive Thor platform aiming to provide the brain for the next generation of autonomous vehicles and humanoid robots. Despite this technological lead, the retail community remains locked in a battle with the bubble narrative. You'll see endless debates on forums about whether the current forward price-to-earnings ratio of 48x is sustainable. Some argue that since earnings are expected to grow by another 50% this year, the stock is actually undervalued compared to historical tech peaks. Others are terrified that the massive capital expenditure from companies like Microsoft and Meta cannot continue indefinitely if they don't see a clear path to monetizing the AI tools they've built. This frustration is compounded by the fact that short interest is relatively low at 1.13% of the float, suggesting that the downward pressure isn't coming from aggressive betting against the company, but rather from a lack of new marginal buyers at these elevated valuations. Institutional activity shows that the big desks are playing a game of chicken. They aren't selling out entirely because the risk of missing the next leg up is too great, but they aren't buying the dips with the same ferocity as before. Instead, they are watching the inference market. For the last few years, the growth was driven by training models, feeding massive amounts of data into clusters to create AI. Now, the shift is towards inference, actually using those models to perform tasks. CEO Jensen Huang has been vocal about the fact that inference will require 100 times more computation power than training, which would theoretically keep the demand for Nvidia's hardware high for years to come. If the world starts seeing widespread adoption of autonomous agents that can execute complex tasks without human intervention, the current valuation of Nvidia might actually look cheap in hindsight. As we look towards the rest of 2026, the potential for a recovery depends on a few specific catalysts. First is the production ramp-up of the Rubin architecture in the second half of the year. If Nvidia can prove that they can maintain their mid-70% gross margins while transitioning to this next-generation silicon, it will silence the critics who think their pricing power is waning. Second is the regulatory environment. The current administration has shown a commitment to winning the AI race, which has led to some easing of restrictions, such as allowing the sale of certain H200 class GPUs to China. This opens a massive market that was previously considered a lost cause for Nvidia's growth projections. Comment below how many shares of Nvidia you currently hold and what your personal price target is for the end of 2026. Do you think the current consolidation is a healthy foundation for a move towards $250? Or are you concerned that the great rotation will continue to drag the tech sector down? The emotional state of the market right now is one of cautious optimism masked by short-term fatigue. Investors who bought in at the $100 level are sitting on comfortable gains and are less likely to panic sell. But the newer cohort that entered near the $200 peak is feeling the sting of a stagnant chart. This creates a situation where any negative headline, no matter how minor, can trigger a wave of algorithmic selling. We saw this recently with the concerns over circular financing, where investors worried that the companies buying chips were doing so with funds provided by the chipmakers' own investment arms. While Nvidia has largely debunked these concerns with its transparent financial reporting, the fear, uncertainty, and doubt factor remains a potent force in the daily price action. Looking at the future outlook through the lens of expectation versus reality, the most likely scenario is a period of continued sideways movement until the next earnings call in late February. The reality of Nvidia's dominance is unquestionable, but the expectation that it should continue to grow at a triple-digit pace is where the friction lies. If the company can demonstrate that its software revenue from the Nvidia AI Enterprise Suite is beginning to scale, it will add a high-margin recurring revenue stream that could justify a much higher multiple. Software currently represents a small fraction of their revenue, but with 80+% margins, it is the secret weapon that many retail investors are ignoring while they focus solely on GPU shipments. Traders should be watching the $180 support level very closely. If the stock breaks below that, we could see a more significant correction towards the $165 range, which would likely trigger a massive buy the dip opportunity for long-term holders. Conversely, if the stock can reclaim the $190 level on high volume, it would signal that the institutional rotation has finished and the next bull leg is starting. The retail community is largely holding the line, with surveys showing that less than 10% of individual investors are planning to cut their positions this year. This diamond hands mentality provides a floor for the stock, but it doesn't provide the upward thrust needed to break through resistance.